Okay, so you want to buy a stock exchange. At first, it sounds almost disappointingly simple. Find a historic building in New York, ring the opening bell every morning, watch billions of dollars worth of stocks change hands, and collect a small fee from every trade. It almost feels like owning the busiest marketplace in the world. But here's the strange part. A stock exchange doesn't own the companies being traded. It doesn't own the shares. It doesn't invest its own money alongside millions of investors. Most of the time, it doesn't even decide which direction the market moves. And yet, some of the most valuable financial institutions on earth are the companies that own these exchanges. That's because the real product isn't stocks. The real product isn't investing. The real product is something far less visible and far more powerful. It's trust turned into infrastructure. Every morning, before Wall Street fully wakes up, before traders place their first orders, before retirement accounts buy another index fund, an invisible machine begins operating. Millions of buy and sell decisions made by pension funds, hedge funds, banks, corporations, and individual investors all converge toward one destination. They are not coming for the building. They are coming for the system that makes strangers comfortable exchanging billions of dollars with people they will never meet. That system is what you're really buying. Most people believe stock exchanges exist to help investors make money. In reality, investors are simply the customers moving through a much larger machine. The exchange earns its living whether prices rise, fall, or move sideways. Bull markets create excitement. Bear markets create fear. But both create transactions, and transactions are where the business begins. The more people participate, the more valuable the marketplace becomes. The more valuable the marketplace becomes, the more participants it attracts. It's a cycle that feeds itself, growing stronger every single trading day. That is why institutions like the New York Stock Exchange and Nasdaq have become far more than places where stocks are listed. They have become financial infrastructure, supporting the movement of capital across an entire economy. But that raises an even bigger question. If the business is so powerful, why doesn't every major bank, technology company, or billionaire simply build a new stock exchange and compete? After all, creating a website sounds easier than constructing an airport or drilling an offshore oil platform. Modern software can match buyers and sellers in milliseconds. Data centers can process millions of orders every second. The technology already exists. The capital certainly exists. So what exactly stops new competitors from appearing every year? The answer has almost nothing to do with computers and almost everything to do with human behavior. Because a stock exchange isn't valuable because it has technology. It's valuable because millions of people believe millions of other people will show up tomorrow. That single expectation creates liquidity. Liquidity creates confidence. Confidence attracts more participants. And before long, an invisible network becomes one of the hardest businesses on earth to replicate. You are not buying a trading platform. You are buying the place where confidence becomes liquidity, and liquidity becomes the financial heartbeat of an entire economy. If confidence is the invisible product, then liquidity is the engine that keeps the entire machine alive. People often imagine a stock exchange as a giant digital bulletin board where buyers and sellers simply meet each other. That picture is comfortable, but it is incomplete. Imagine walking into a flea market with 100 sellers and only 2 buyers. Every seller wants the highest price. Every buyer wants the lowest. Deals happen slowly, prices become unpredictable, and many people leave without making a transaction. Now imagine another market with 1 million buyers and 1 million sellers arriving every day. Suddenly, almost every item can find a buyer within seconds. Prices become clearer because thousands of people constantly compete with one another. The market becomes faster, more efficient, and more trustworthy. That difference is liquidity. It is not a physical asset you can touch. It is a behavior created when enough participants believe everyone else will also participate. This is why a stock exchange becomes stronger as it becomes larger. Every new investor improves the experience for every existing investor. Every additional company listing attracts more analysts, more institutional investors, and more trading activity. More activity creates narrower bid and ask spreads. Narrower spreads reduce trading costs. Lower costs attract even more investors. The cycle repeats endlessly, turning participation itself into one of the most valuable assets on the balance sheet. This phenomenon is known as a network effect, but unlike a social media platform where users exchange messages or photographs, this network exchanges confidence. Every order placed tells the next participant that someone else is willing to buy or sell at that moment. Every completed transaction strengthens the belief that the market will still function tomorrow morning. That expectation becomes incredibly difficult to replace. This is why many exchanges that were founded more than a century ago continue to dominate global finance today. The buildings may have changed. Trading floors may have become quieter as computers replaced shouting brokers. But the accumulated confidence remains. Consider the New York Stock Exchange. Thousands of companies have listed their shares there over generations. Pension funds trust it. Mutual funds trust it. Insurance companies trust it. International investors trust it. That trust was not built by software alone. It was earned through decades of reliable operation, regulatory oversight, transparent rules, and consistent execution. Nasdaq followed a different path by embracing electronic trading earlier than many traditional exchanges, yet it ultimately achieved the same objective. It convinced millions of participants that orders would be matched fairly, quickly, and efficiently. Once enough people accepted that promise, the network began growing almost automatically. This creates one of the most unusual competitive advantages in the financial world. The largest exchange is not necessarily the smartest. It simply becomes the place where everyone expects everyone else to be. Trying. To build a new exchange means convincing millions of investors, thousands of brokers, hundreds of institutional firms, market makers, regulators, and publicly traded companies to move together at exactly the same time. If only one group hesitates, liquidity weakens. If liquidity weakens, confidence fades. And if confidence disappears, the marketplace loses the very product it was supposed to sell. That is why the greatest asset inside a stock exchange is not its matching engine, its headquarters, or even its technology. The greatest asset is the shared belief that tomorrow morning, when markets open once again, everyone else will still be there. Once enough people trust the marketplace, the next question becomes surprisingly simple. How does the owner actually make money? Most people imagine that every dollar flowing through the market somehow belongs to the exchange. It does not. Every share still belongs to investors. Every gain belongs to the buyer who made the right decision. Every loss belongs to the seller who made the wrong one. The exchange keeps neither. Instead, it earns money by making sure the entire machine continues to operate with extraordinary precision. Think about a modern airport. The airport does not own the passengers. It does not own the airplanes. It simply operates the infrastructure that allows both to meet efficiently. A stock exchange works in much the same way. Every time an investor presses the buy button through a brokerage account, a chain of events begins almost instantly. The order travels from the investor to a broker. The broker forwards the order into the exchange. Inside massive data centers filled with highly specialized computers, an electronic matching engine searches through thousands of existing orders waiting on the other side of the market. Within fractions of a second, the system identifies the best available match according to strict market rules. The transaction is confirmed. The trade is recorded. The information is distributed across financial markets around the world almost immediately. To the investor, everything appears effortless. Behind the scenes, however, thousands of calculations have already taken place. Every one of those transactions generates value for the exchange. The fee charged on a single trade may appear almost insignificant. Measured one transaction at a time, it is easy to overlook. But when millions of trades occur every day, tiny fees become remarkably predictable streams of revenue. That is only the beginning. Companies that want their shares listed pay listing fees because access to a trusted marketplace provides visibility, credibility, and access to investors across the world. Financial institutions purchase market data because seeing prices even a fraction of a second faster can improve investment decisions. Trading firms rent physical space inside exchange data centers through a practice known as co-location because reducing the distance between their computers and the exchange by only a few feet can reduce communication delays by tiny fractions of a second. Those fractions may sound meaningless to ordinary investors, yet across millions of transactions they become commercially valuable. The exchange is not simply selling transactions. It is selling access, speed, reliability, transparency, and information. Over time, these businesses become just as important as trading itself. In fact, many of the world's largest exchange operators generate substantial revenue from data services, technology platforms, index licensing, and financial infrastructure that many investors never notice. The marketplace becomes an ecosystem where every participant pays for a different layer of certainty. Investors pay for execution. Listed companies pay for access to capital. Brokers pay for connectivity. Institutions pay for information. Technology firms pay for integration. Everyone purchases a different service, but they all rely upon the same invisible foundation. This creates another remarkable paradox. The exchange becomes more profitable not because it predicts the future better than anyone else, but because it never has to predict the future at all. Whether optimism fills the market or uncertainty slows it down, as long as participants continue trusting the system enough to interact, the machine continues converting activity into revenue, one transaction at a time. By now, the business looks almost unstoppable. Every transaction generates revenue. Every new participant strengthens the network. Every additional service creates another source of recurring income. It almost sounds like the perfect monopoly. But that assumption hides the biggest misunderstanding of all. A stock exchange does not become powerful because governments declare it powerful. It becomes powerful because every participant voluntarily chooses the same destination. That difference changes everything. Imagine opening a brand new exchange tomorrow morning with unlimited funding, the fastest computers in the world, and a beautiful headquarters in the middle of Manhattan. The software works flawlessly. The transaction fees are lower than anyone else. The technology outperforms every existing competitor. Yet when the opening bell rings, almost nobody arrives. Investors hesitate because there are too few sellers. Sellers hesitate because there are too few buyers. Large institutions hesitate because daily trading volume is too small. Public companies hesitate because they want access to deep pools of capital. Brokers hesitate because their customers expect immediate execution. Every participant waits for someone else to move first. The marketplace enters a silent standstill. Nothing is technically broken. Nothing is legally prohibited. But without shared confidence, the machine never truly starts. This is the hidden monopoly that few people notice. It is built on collective behavior rather than exclusive ownership. The strongest exchanges in the world spent decades accumulating that behavior one participant at a time. Every successful initial public offering encouraged another company to list its shares. Every reliable trading session encouraged another pension fund to increase its activity. Every year of uninterrupted operation strengthened the expectation that tomorrow would look much like today. That accumulated expectation became more valuable than almost any physical asset the exchange could own. This is why mergers between exchange operators have become some of the most important transactions in modern finance. Companies such as Intercontinental Exchange, which acquired the New York Stock Exchange, and London Stock Exchange Group expanded far beyond traditional trading floors. They recognized that the true competitive advantage was never the building itself. It was the network surrounding it. Market data, clearing services, index businesses, financial analytics, and technology platforms all reinforce the same ecosystem. Every additional service makes leaving even more difficult. A broker already connected to the exchange purchases data feeds. Asset managers build investment products around its indexes. Software providers integrate directly into its infrastructure. Listed companies develop long relationships with investors who expect those shares to remain in familiar markets. Over time, switching becomes increasingly expensive, not because contracts force anyone to stay, but because the entire financial community has organized itself around the existing network. This creates an extraordinary economic moat. Unlike a bridge that controls one river crossing or an airport that controls one geographic location, a stock exchange controls expectations. The product grows stronger every time another institution decides it is still the safest place to transact. That is why ownership of an exchange is far less about controlling trades than controlling confidence itself. But confidence, no matter how powerful, introduces a different challenge. The larger the network becomes, the greater the responsibility to keep every second of every trading day operating without interruption. Because the moment confidence pauses, even briefly, the entire machine is tested. That responsibility extends far beyond matching buyers and sellers. Every trading day begins long before the opening bell and continues long after the closing bell because the marketplace is supported by an entire financial ecosystem operating beneath the surface. Every completed trade must eventually become a completed transfer of ownership. That sounds obvious until you remember that millions of transactions occur every day between investors who have never met each other. Someone has to verify that the buyer has the money. Someone has to verify that the seller actually owns the shares. Someone has to guarantee that both sides fulfill their obligations even if unexpected problems arise along the way. This is where clearinghouses and settlement systems quietly become some of the most important institutions in modern finance. They rarely appear in headlines. Most investors never think about them. Yet without them, confidence would quickly begin to erode. Imagine buying a house without a title company, a bank, or legal records confirming ownership. Every transaction would require personal trust between strangers. Markets would slow to a crawl. The same principle applies here, except instead of a handful of real estate transactions, the system processes enormous volumes of financial activity every single day. The exchange therefore becomes only one visible component of a much larger machine built around verification, reconciliation, and certainty. This hidden infrastructure also explains why exchange operators continue expanding beyond traditional trading businesses. Intercontinental Exchange owns technology platforms serving mortgage markets. London Stock Exchange Group strengthened its position through financial data and analytics. Nasdaq provides technology used by exchanges and market operators around the world. These companies gradually transformed themselves from marketplaces into infrastructure providers. Trading may attract public attention, but infrastructure produces durable relationships. Every financial institution connected to these systems becomes another long-term customer. Every software integration creates another reason to remain inside the network. Every regulatory approval strengthens barriers that newcomers must overcome. As the ecosystem expands, the value of every individual component increases because each supports the others. Market data improves trading decisions. Trading activity enriches market data. Indexes become benchmarks for investment funds. Investment funds generate additional transactions. Additional transactions increase demand for technology, connectivity, and analytics. The cycle reinforces itself continuously. What began as a marketplace gradually evolves into a complete operating system for capital markets. That evolution also changes the nature of competition. A new rival no longer competes against a single exchange. It competes against an entire financial ecosystem that has spent decades integrating itself into banks, brokerages, asset managers, regulators, technology vendors, and institutional investors across the world. Replacing one component suddenly requires replacing dozens of interconnected relationships at the same time. That challenge becomes exponentially more difficult with every passing year. The exchange no longer succeeds simply because trades occur within its walls, whether physical or digital. It succeeds because countless organizations have quietly built their daily operations around the assumption that this infrastructure will continue functioning with extraordinary reliability tomorrow, next month, and many years from now. Yet the more essential the system becomes, the less room there is for error. A single interruption is no longer measured only in minutes of delayed trading. It becomes a direct test of the confidence that the entire marketplace has spent generations building. Confidence is surprisingly fragile because it is built on expectations rather than concrete objects. A bridge can be inspected. A factory can be visited. A power plant can be measured by the electricity it produces. A financial marketplace depends on something far more intangible. Every participant expects that every quoted price is accurate, every completed trade is genuine, every rule is applied consistently, and every transaction will settle exactly as promised. Maintaining those expectations requires constant investment in technology, cybersecurity, compliance, surveillance, and operational resilience. Behind every visible market lies an invisible control room where engineers monitor systems, risk specialists analyze unusual activity, compliance teams verify regulatory standards, and technology experts prepare for situations that ordinary investors never notice. Success is measured by how little the public ever thinks about these operations. The smoother everything functions, the more invisible the infrastructure becomes. That creates one of the strangest business models in the modern economy. Customers rarely appreciate the product while it works perfectly. They only recognize its importance when something interrupts the normal flow. Even a brief technical disruption reminds the financial world that billions of dollars depend upon systems operating continuously with extraordinary precision. This explains why exchange operators spend enormous resources building redundancy into every critical function. Multiple data centers operate simultaneously. Backup communication networks remain ready. Critical systems are continuously tested. Recovery procedures are refined long before they are ever needed. Every additional layer of reliability protects something much larger than a single trading session. It protects decades of accumulated confidence. The challenge becomes even greater as markets become increasingly global. Investors in New York monitor prices in London. Portfolio managers in California follow developments in Tokyo before sunrise. Pension funds allocate capital across continents. Large corporations raise money from investors located around the world. Information now travels almost instantly, which means expectations travel just as quickly. A disruption in one important marketplace can influence confidence far beyond national borders because financial networks have become deeply interconnected. This growing complexity has also transformed exchanges into technology companies as much as financial institutions. Software development, cloud infrastructure, artificial intelligence, data analytics, and high-performance computing now play roles that would have seemed unimaginable only a few decades ago. Yet despite all of this technological progress, the central mission has never changed. Every innovation ultimately serves the same purpose: reduce uncertainty, increase transparency, preserve confidence. The remarkable irony is that the better these organizations perform, the less attention they receive. Investors celebrate successful investments. Companies celebrate successful public offerings. Fund managers celebrate strong returns. Very few people celebrate another ordinary trading day where everything simply worked exactly as expected. That quiet success is precisely the achievement the exchange seeks every morning. It is building an environment where millions of independent financial decisions can occur without participants questioning whether the marketplace itself will remain dependable. But that raises another question that every owner must eventually confront. If the exchange does not control stock prices, economic cycles, or investor emotions, what happens when fear spreads through the market faster than confidence can contain it, and can even the strongest infrastructure continue generating value when uncertainty itself becomes the dominant force driving every decision? The surprising answer is yes, but not for the reason most people expect. Financial markets are designed to function during periods of confidence as well as periods of uncertainty. In fact, uncertainty often increases activity rather than stopping it. When investors disagree about the future, some rush to buy while others decide to sell. Prices move more rapidly. Trading volume frequently increases. News travels faster. Analysts publish new forecasts. Portfolio managers rebalance positions. Companies respond with updated guidance. Every participant reacts differently, yet they all continue relying on the same marketplace to discover fair prices. This reveals another paradox hidden inside the business. An exchange does not prosper because everyone agrees. It prospers because millions of participants are free to disagree while trusting the same set of rules. That trust transforms uncertainty into continuous price discovery instead of disorder. Consider what happens during an ordinary trading session. Every second, thousands of opinions collide. One investor believes a company is undervalued. Another believes the same company has become too expensive. Neither knows the future with certainty. The exchange never attempts to decide who is correct. Its responsibility is far more neutral. It provides a transparent environment where competing opinions become observable prices. Those prices then become signals for pension funds, retirement accounts. Businesses, lenders, governments, and consumers making economic decisions far beyond the stock market itself. The marketplace gradually becomes an information system for the entire economy. Every transaction contributes another small piece of evidence about how capital is being allocated. Every quoted price reflects countless expectations about earnings, innovation, interest rates, consumer demand, and future growth. The exchange does not create those expectations. It organizes them into information that everyone can observe simultaneously. That information becomes valuable long after the individual trade has been completed. Researchers analyze it. Fund managers build strategies around it. Companies evaluate acquisitions using it. Regulators monitor systemic conditions through it. Economists study long-term trends with it. Financial journalists explain changing markets because of it. The exchange quietly converts millions of independent decisions into a public reference point used across the financial system. This explains why transparency becomes just as important as speed. Investors must believe that everyone sees the same rules, receives accurate information, and competes on a marketplace designed to operate fairly. Once that expectation weakens, participation becomes more cautious, liquidity becomes thinner, and confidence becomes harder to sustain. Protecting fairness therefore becomes an economic function rather than simply a legal obligation. It safeguards the willingness of future participants to continue entering the market. Ironically, the exchange succeeds best when it remains emotionally detached from every outcome. Rising markets generate optimism. Falling markets generate caution. Individual companies celebrate successful years or navigate disappointing ones. Entire industries rise and decline over decades. Through all of those cycles, the marketplace performs the same essential task every trading day. It keeps capital moving, information flowing, and confidence organized into a system that millions of people can continue relying upon. Yet even a system built on transparency, technology, and trust faces one unavoidable reality. No marketplace can completely eliminate risk. It can only create an environment where risk is measured, transferred, priced, and understood more efficiently than it could be anywhere else. That distinction is exactly what separates a successful exchange from an ordinary technology platform. The objective has never been to eliminate uncertainty. The objective is to create a marketplace where uncertainty can be expressed openly, evaluated continuously, and transformed into informed decisions. Every investor who enters the market accepts that prices may change. Every company understands that its valuation will rise and fall as new information becomes available. Every institution recognizes that expectations evolve faster than forecasts. The exchange does not promise certainty. It promises a reliable process for discovering reality one transaction at a time. That promise, however, is constantly challenged by forces far beyond the control of any marketplace. Interest rates change. Inflation rises or falls. New technologies reshape entire industries. Consumer behavior shifts. Elections introduce new policies. International trade patterns evolve. None of these events originate inside the exchange, yet all of them eventually appear within it. The marketplace becomes a mirror reflecting the changing expectations of an entire economy. Sometimes that reflection is optimistic. Sometimes it becomes cautious. Occasionally it changes with remarkable speed. Throughout every cycle, the responsibility of the exchange remains exactly the same. Keep the market open. Apply the rules consistently. Ensure transparent price discovery. Maintain confidence in the infrastructure itself. This is why exchanges invest so heavily in governance, oversight, surveillance systems, and operational controls. They understand that their greatest competitive advantage can disappear if participants begin questioning whether the marketplace remains fair. Confidence is accumulated slowly but can weaken surprisingly quickly if transparency is compromised. Protecting that confidence therefore becomes one of the highest priorities in the entire organization. It also explains why regulators, listed companies, institutional investors, brokers, and exchange operators often share the same long-term objective even when their immediate interests differ. All of them benefit from a marketplace that participants believe is dependable, transparent, and resilient. Without that shared confidence, capital becomes more cautious, companies find it more difficult to raise funding, investors demand higher compensation for uncertainty, and economic growth itself becomes less efficient. The exchange therefore performs a role extending far beyond buying and selling securities. It quietly lowers the cost of trust across the financial system. That invisible contribution rarely appears in financial statements, yet it influences nearly every participant connected to modern capital markets. Ironically, this also means the exchange cannot afford to think only about today's trading volume. Every decision must consider how it affects confidence years into the future. A short-term advantage that damages credibility may ultimately cost far more than it ever earns. Long-term trust becomes the most valuable asset on the balance sheet, even though it cannot be measured as easily as revenue or profit. This creates another remarkable paradox. The strongest exchange is not necessarily the one that charges the highest fees or processes the greatest number of trades on a single day. It is the one that convinces millions of participants that the marketplace will remain dependable through changing technologies, changing economies, and changing generations. Once that belief becomes deeply established, the exchange evolves into something much larger than a financial marketplace. It becomes critical infrastructure supporting the movement of capital across an entire nation. And that leads to the final question every owner eventually confronts. After building one of the most trusted financial institutions in the world, what exactly is it that you truly own at the end of the journey? The answer is both simpler and far more extraordinary than most people imagine. You do not truly own the stocks. Those belong to investors. You do not own the companies. They answer to their shareholders. You do not own the capital flowing through the market. It constantly moves from one opportunity to another. Even the prices themselves belong to no one because they change every second as new information reaches the marketplace. What you ultimately own is the system that allows all of those independent decisions to become one coherent market. You own the infrastructure that transforms trust into liquidity, liquidity into price discovery, and price discovery into capital formation. Every entrepreneur raising money to build a new business depends upon that system. Every family saving for retirement depends upon that system. Every pension fund supporting millions of workers depends upon that system. Every institution allocating capital across the economy depends upon that system. None of them are required to think about the exchange every day, and that is precisely what makes the business so remarkable. The greatest compliment a marketplace can receive is becoming invisible. When investors focus entirely on their decisions instead of questioning the infrastructure beneath them, the system has succeeded. That invisible role explains why exchange operators have become some of the most durable businesses in global finance. They are not competing to predict the next winning company. They are creating the environment where every company can compete for capital. They are not attempting to forecast tomorrow's market direction. They are ensuring that whatever tomorrow brings, millions of participants can continue discovering prices together. This is why the exchange remains valuable during technological revolutions, economic expansions, periods of uncertainty, and changing generations of investors. Individual businesses may disappear. Entire industries may evolve. New financial products will emerge. Artificial intelligence may transform investment research. Trading technology will certainly continue advancing. Yet the underlying need remains remarkably constant. Capital must find opportunity. Investors must find liquidity. Companies must find funding. Markets must find trusted rules. As long as those needs exist, the infrastructure connecting them continues creating value. That leads back to the paradox we began with. From the outside, a stock exchange appears to be a place where securities are bought and sold. From the inside, it is one of the world's most sophisticated trust machines. Every line of computer code, every regulatory standard, every technology upgrade, every listing requirement, every market data feed, every settlement process, and every trading session exists to answer one simple question. Can complete strangers confidently exchange enormous amounts of capital under the same transparent rules? When the answer remains yes, the entire economy benefits. So if you ever found yourself imagining what it would be like to own one of these institutions, remember that the greatest asset is not a trading floor, a matching engine, or even the billions of dollars moving across the screens each day. The greatest asset is the confidence that millions of people will return tomorrow, trust the same marketplace once again, and continue transforming individual decisions into the financial heartbeat of an entire economy. That is not simply ownership of a business. It is ownership of one of the invisible systems that allows modern capitalism itself to function.